All right, let's get right into it. We all trust banks with our money, our savings, our mortgages, pretty much our entire financial lives. But what or who is really keeping them in line?
I mean, really think about that for a second. Who is the ultimate guardian angel making sure the bank that holds your paycheck doesn't just, gamble it all away on some crazy high-risk bet?
And look, the first thing that probably pops into your head is the government, right? You're picturing these official supervisors, the central banks, people in suits poring over spreadsheets. They're the designated watchdogs, and they build this whole complex web of rules to keep the system from blowing up.
And don't get me wrong, they are absolutely essential. But what if I told you they're not the only ones pulling the strings? What if there's another, much less obvious, but seriously powerful regulator that most of us never even think about?
This is where it starts to get really interesting, because that hidden regulator, well, it's you, and it's me. It's us, the customers.
That's right. It's not about any single person's decision. It's the collective force of all of our choices put together. Every single time we choose a bank for a savings account or a business applies for a loan, we're casting a vote, we're sending a signal. And all those signals together create this powerful current that can actually steer the whole industry.
And listen, this isn't just some random, quirky idea. It's a formal economic theory called market discipline. And it is so important that it's actually one of the main pillars of the global rules for banking.
So what is it exactly? Put simply, market discipline just means that we, the customers and the creditors, have the power to keep an eye on what banks are doing and, well, make them pay a price for being reckless.
And this slide just shows you how big of a deal it is. The International Banking Rulebook, known as the Basel Accords, is built on 3 pillars. Pillar 1 is about banks having enough of their own money on the line. Pillar 2 is about those official government supervisors. But then look at Pillar 3, market discipline. It's right there, on equal footing as a fundamental piece of the puzzle for keeping the whole global financial system stable.
Okay, so how does this thing actually work in practice? Well, market discipline really comes from 2 different sides of the bank's business, and they act in totally different ways. You've got the depositors, and you've got the borrowers.
The easiest way to think about it is like a carrot and a stick. Depositors, that's anybody with a savings account, they're the ones with the stick. If we think a bank is getting a little too risky, we can punish it. We can demand higher interest rates on our savings, or if things get really bad, we just pull our money out. On the flip side, borrowers offer the carrot. Research actually shows they're often willing to pay a little extra, a higher interest rate on a loan, just to do business with a bank that they know is safe and solid.
Now that might sound a little weird, right? Why on earth would anyone want to pay more for a loan? Well, the theory says there are 2 big reasons. First is what's called the refinancing solvency motive. Basically, if you're a business, you need your bank to still be standing tomorrow and the day after to extend your credit line. You'll pay a bit more for that security. The second reason is the certification signaling motive. Getting a loan from a really reputable top-tier bank is like getting a gold star. It signals to all your suppliers, your investors, your own customers that you are a solid, trustworthy business.
Okay, so this all sounds fantastic on paper, a self-correcting market that keeps banks from going off the rails. But the billion-dollar question is, does this elegant theory actually work when it slams into the messy, complicated reality of the real world? Let's see what the evidence says. All right, so let's look at the report card here, which pulls from a few different studies, and the results are kind of all over the map. In Mexico, they found that depositor discipline was pretty weak. On the borrower side, yeah, it worked, but, and this is a huge but, it didn't apply to the 7 biggest banks. They were basically immune. Over in Kyrgyzstan, the theory held up great. Borrowers there did pay more to safer banks. But then a big study across Central America found pretty much no evidence of depositor discipline at all.
So the big takeaway here is that no, market discipline is not just a myth. It's a real thing. But it's definitely not some kind of magic wand we can wave. The signal it sends can get really faint or even completely drowned out by other, much louder forces in the economy.
So what are these forces? What are these things that can kill market discipline out in the wild? Well, researchers have zeroed in on a few key culprits.
There are 4 big ones that seem to pop up again and again. You've got the whole too big to fail problem. You've got government safety nets like deposit insurance. There are these huge macroeconomic trends that just steamroll everything. And of course, the simple fact that we customers don't always have all the information we need. Let's dig into a couple of these.
Let's start with just one number, 80%.
That 80% is the share of the entire Mexican banking system that's controlled by just 7 massive banks. And remember that study we just mentioned? It found borrower discipline worked for smaller banks, but was totally absent for these giants. And why is that? Well, because everyone just assumes the government would never, ever let one of them collapse. They are, quite literally, too big to fail. And that perception just erases the incentive for customers to discipline them.
Next up, deposit insurance. Now, this one is a classic double-edged sword. It is absolutely vital. It prevents bank runs and it protects everyday savers like you and me. But by guaranteeing our money is safe up to a certain point, it also takes away our reason to worry about how risky our bank is. I mean, if you know your money is safe no matter what the bank does, why would you bother monitoring it? And that effect has been shown to really weaken depositor discipline.
And finally, sometimes the big picture just completely takes over. A huge study across Latin America found that these broad macroeconomic forces, like a country going into a recession or experiencing a boom, had a way bigger impact on bank behavior than the specific riskiness of any one bank. The little signal from a single bank just gets lost in the thunder of the overall economy.
So where does all of this leave us? Well, I think it's with a pretty clear understanding. Market discipline is a genuine, real force that can and does shape how banks behave. But it is not a silver bullet. It's not a perfect, all-powerful regulator that can solve all our problems.
Is one of those 3 pillars of bank stability for a very good reason. But it's a pillar that can get hairline fractures or even big cracks from things like government safety nets, from having just a few giant players, or from massive economic shocks. It seems to work best when it's working with official supervision, not as a replacement for it.
And that, really, brings us to our final, lingering question. The evidence seems pretty clear that the market really struggles to discipline the largest, most important banks in the system. We also know from history that official regulators, for all their hard work, can't stop every crisis. So, if both the market and the regulators have their limits when it comes to the biggest players, who's left? Who can really hold them accountable? That's definitely something to chew on.